Ever feel like investors are speaking a completely different language?
You're not alone, but that ends today.
We are breaking down investing terms in plain English
with real-world examples so they actually stick. The purpose of this video is to give you the basic building blocks of the investing vocabulary so you can enter the investing world.
Welcome to How to Invest. Tap like and hit subscribe. This first section is basic terminology.
What is a company? A company is a legal group of people that come together to sell goods and services with the end goal of making money. Companies have their own legal rights like a person does. An example would be Nike. They produce shoes and other athletic goods and sell them all around the world.
What is investing? Investing means putting your money into something like stocks, real estate, or a business with the goal of making money over time. An example of this is if you buy a stock today for $100 and sell it later for $150, that's investing. You used your money to hopefully make money.
What is a stock? A stock represents a small piece of ownership in a company. An example would be Nike stock. You can buy some Nike stock and you literally own a piece of Nike. This raises the question though, why would a company want to sell stock? A company sells stock to raise funds, to hire more people, to build out new factories, to pretty much fuel future growth for that company. It's a way to raise money. So when you buy a stock, you're actually helping build the future of tomorrow.
What is a share? A share is a single unit of stock. If a company has 1,000 shares and you own 10, you own 1% of the company. Even simpler, if you and a friend start a company and they have one share and you have one share, you own 50% of the company.
What is a stock exchange? A stock exchange or a stock market is simply a place where people come together to buy and sell stocks. The US has quite a few with the New York Stock Exchange and the NASDAQ. Europe has its own ones as well as other countries around the world. Think of it kind of like an Amazon for stocks.
Ticker symbol. This is a stock's unique abbreviation in the stock exchange. Apple's ticker symbol is AAPL. So you use that abbreviation to search in that stock market for that specific company. This is really helpful when you have a company with a very long name and you don't want to type it out every single time, and you can just use their short couple letter abbreviation to find them. Portfolio. A portfolio is the full collection of all your investments. So if you own a little bit of Apple, a little bit of Tesla, and some real estate, that is your portfolio.
Dividend. A dividend is a payment from a company to the shareholders or stockholders of that company. So remember earlier when the company sold us their stock so that they can invest in factories, hiring more employees? Well, now they're past that stage and now they're making the profit from those factories and those hire workers. And now they're paying it back to the shareholders for that investment.
Section number 2 is market moves and metrics. What is a bull market? A bull market is where the stock prices are generally rising. That doesn't mean they don't fall at all, but their trend is consistently upwards. The reason that they call it a bull market is because when a bull is charging, it raises its horns, going in an upward direction.
Bear market. A bear market is the opposite of a bull market. Prices are consistently going down over time. The stock prices are decreasing. For a bear market, you can think of a bear striking down, and that's the direction of price.
What is volatility? Volatility is how much a stock's price moves up and down. For example, if Tesla jumps up 10% in one day, and then the next drops 8%, that is high volatility.
Market cap. Market cap is the total value of all of the shares of the company. So if a company has 1,000 shares and each share is worth $1, the market cap is $1,000.
What if people are willing to pay $2 for a stock in a company?
So that would actually increase the market cap because the market cap is calculated by stock price times number of shares. So if you increase the value of each share from $1 to $2, now your market cap is $2,000.
Okay, so the market cap is always changing depending on how much people are willing to pay for a stock.
Yeah, exactly.
Cool. Volume. Volume is the number of shares traded in a specific period of time. If 1 million shares of Netflix are traded in a day, its volume is 1 million shares.
The PE ratio, or price to earnings ratio, shows how a company's market cap, its price, compares to what the company earns. It's earnings, price to earnings. The equation is market cap divided by earnings, or its profit. If a market cap is $100 and its earnings is $5, the PE ratio is 20. This number helps you know if a stock is a good price or maybe overpriced. The stock market average PE is 24. Or in other words, it takes 24 years of earnings to pay for the entire market cap or price of the company.
EPS, earnings per share. This is a company's profit divided by the number of shares it has. If a company earns $2 million in profit and has 1 million shares, its EPS is $2.
Liquidity. Liquidity is how easily something can be turned into cash. An example of this would be Apple stock. It has a high level of liquidity because there's lots of people in the market wanting to buy Apple stock today. A house, maybe not so much. You have to find a real estate agent, list it on the market for perhaps a couple of months to find the right buyer. So it has much lower liquidity.
Section 3 is about types of stocks and types of investors. Blue chip stock, or stalwart stock, is a large, reliable company with a solid track record. Think about Coca-Cola or Microsoft. They've been around forever and they are financially strong.
Growth stock. A growth stock is a company that is quickly growing revenue and earnings. A classic example of a growth stock is Tesla. It's been growing rapidly, but comes with higher risk.
Value stock. A value stock is a stock that appears to be underpriced based on fundamentals like the PE ratio and how much it's growing. It's like finding a $100 bill on sale for $80. It's the same value, but it has a better price.
Dividend stock. A dividend stock is a stock that pays regular income to its shareholders or stockholders. An example would be a company that is past its growth stage. It has a very robust financial situation and has a lot of excess cash, but it can't really find new ways to invest that cash back into the business to produce future revenue. So instead, it decides to pay that cash as income to the shareholders.
Retail investor. This is an individual investor using their own money to be a part of the stock market. This is someone like me and is someone like you. So if you open up an M1 or Robinhood account, you can buy stocks. You are a retail investor.
Institutional investor. An institutional investor is an organization that invests large sums of money. Examples can be like BlackRock, pension funds, sovereign wealth funds, banks. Usually they're managing hundreds of millions, if not billions of dollars.
Section number 4 is buying, selling, and strategy. Buy, sell, hold. These are 3 basic choices when investing in a stock. If you bought Amazon years ago and you still believe in it, you might choose to hold on to the stock.
Market order versus limit order. Depending on what institution you decide to invest in, it might ask you if you want to do a market order or a limit order. A market order is basically the going price, and the institution will just sell your stock at whatever it can get for it. A limit order puts a certain price limit on it, perhaps the top or bottom of what you're willing to sell the stock for, and it will only sell if the actual market price comes into that range. If Tesla stock is at $200 and you put in a market order, it means you'll pay $200 for it. If you put in a limit order, perhaps at $180, your purchase will only go through if the market value of the stock drops to $180. Otherwise, your purchase will not go through.
Bid, ask, and the spread. This is the gap between what buyers want to pay, their bid, and what sellers are asking for, what they want to get. If a buyer offers $98 and seller wants $102, the $4 gap is the spread.
Long versus short. If you're long a stock or the stock market, you're betting that prices are going to increase over time. If you're short, you're thinking that the prices are going to be decreasing. An example of going long a stock would simply be buying that stock and holding it until the future when you think that stock will be worth more money. Shorting a stock can be done in a lot of ways, and there's a ton of financial instruments in order to short a stock. They're much riskier, and we're not going to really talk about that today. It's a much more complicated and in-depth topic. And typically on our channel, we talk about going long stocks. We want stocks that are going to be growing a ton in the future. So we're mostly going to be teaching going long anyways.
What is diversification? This is spreading your investments across different companies or different types of investments to reduce risk. So instead of putting all your money into Tesla and Ford, which they're in the same industry, you might put some of your money into Tesla, some of your money into real estate, and some of your money into Coca-Cola, because Coca-Cola is completely different from real estate and automobile manufacturing.
Risk tolerance. Risk tolerance is how much market volatility you're emotionally and financially okay with dealing with. An example of someone with low risk tolerance might be someone who panics when the stock market drops. So you might want to invest in safer investments, which is fine. Someone with a higher risk tolerance might be able to watch their portfolio drop 80% and be totally fine with that. That means you have a very high risk tolerance.
Revenue or sales versus profit. Revenue is the total income that the company takes in, where profit is what's left after all of their expenses. If a business makes $10,000 in sales and has $6,000 in expenses, like paying their workers, paying for their buildings, anything like that, cost of goods, then their profit after the fact is $4,000. Margin, specifically profit margin. This is the percentage of revenue or sales that becomes actual profit. If a company makes $1,000 and keeps $300, then its profit margin is 30%.
Net worth. Net worth is what you own minus what you owe. So if you own $15,000 in stocks, but you owe $5,000 on your credit card, your net worth is $10,000.
You're almost to the end. Thanks for watching this far. Here are some bonus terms.
An ETF, or exchange traded fund. An ETF is a bundle of stocks that you invest in all at once by simply just purchasing the ETF. An example of this, and the most common ETF, is the S&P 500, which is a collection of the top 500 US companies. It gives you exposure to all 500 companies by simply purchasing the single ETF.
I have a question, Aaron. Is an ETF similar to a stock? It's just a group of stocks?
You can think of it kind of like a basket. So it's just a basket that holds a bunch of different stocks from a bunch of different companies in it, and you're purchasing just the basket. A lot of people like ETFs because it's an instant form of diversification. You don't have to buy a bunch of different stocks. If you own an ETF, you own hundreds of stocks.
Index. Index is a group of stocks used to represent part of the market. Using the S&P 500 in this case isn't talking about it as an ETF, but just as a gauge on the market as a whole, because it shows the top 500 US companies and how they're doing overall.
An IPO, or initial public offering, is when a private company sells its shares to the public for the very first time. A little funny bit on this, Warren Buffett likes to call IPOs is it's probably overpriced. Most IPOs typically go down in price after the first couple of days.
Brokerage account. This is the account you use to buy and sell stocks. An example of this is Robinhood. I use M1, and there are many others that you can use so that you can start investing in stocks.
The last definition for today is the capital gains tax. And hopefully this is actually something you come across a lot, because the capital gains tax is the tax you pay on the profit for selling your investments. An example is if you bought Google at $100 and later sold it for $150, you have $50 of capital gains, and you pay the capital gains tax on that $50.
You just learned some essential investing terms. You're gonna run into a lot more terms that you don't know and don't understand. We recommend looking them up. You don't need to feel overwhelmed. Even if in the beginning you need to look up multiple words in a single document, or when you're listening to an earnings call.
If you don't know what an earnings call is, go and look that up now. And we recommend starting by listening to one from your favorite company. If you have any questions or you have any suggestions of topics we should dive into in future videos, drop them in the comments below.
Thank you for watching How to Invest. Next up in this series will be investing for beginners.
And as well,
Oh, woo, woo!
yeah.
Okay.
You can talk more level.
What's a bull market?
Yeah.
Sorry.
What is it?
Yeah.
I don't know. Okay.
What is a bull? Yeah.
I'm making this video to ask you how to invest. You thought you were here to get invested.
Yeah. That was good. Yeah.
Peanut lunch.
End card.